we're thinking about the possibility of more breadth to hit the market, for more stocks to start to catch up, what would it finally take for some of the more badly beaten sectors? You think the regional banks, you think some of the housing some of the parts of the housing market here, what would it take for them to feel some love here?
Well, both of those are challenged to say the least. I mean, because with the strength that this economy has shown, that has surprised everyone. I mean, economists and the Fed. Take a look at Fed GDP projections. We are way above them. They have smiles on their face. Hey, we're in a happy place. I mean, look, we got a strong economy. Inflation is coming down, not as fast as some people had hoped, but certainly on the trend down. There's no incentive right now for them to lower rate. Now, if there's no incentive for them to lower rates, that does challenge real estate. And that challenges these banks, these smaller banks that do make up quite a bit of some of these smaller indexes that we're talking about, because they hold the commercial real estate that has to be rolled over. And, I talk to a lot of people and they say, I don't think I can roll over at a Fed funds rate of 5.5.
Well, it begs the question, Professor Siegel. I want you to comment here on the Fed funds rate for a moment, because the market is still pricing in at least a June rate cut. Do you think, given what you're saying about the PCE data next week, that June rate cut is in the bag?
No, I think nothing is in the bag when it comes to the Fed. I don't think the Fed officials, are in the bag. I mean, before June, we're going to have 2-3 more inflation cycles, job cycles. Things can certainly turn around. We could see exhaustion of the consumer. We could see some of the interest rate challenged sectors begin to depress the market. It just has not happened yet. But I say June is not in the bag, can go either way. And the Fed itself, on March 20th, we're going to get certainly the Fed meeting. And we'll see the dot plot. I expect it to be more aggressive than what we saw in December. In other words, not as many rate cuts as we saw in December.